Joining us now, Olu Omodunbi, Huntington Private Bank chief economist. Olu, thank you for being here. You just heard a little bit about the potential tension between the Federal Reserve and Jay Powell and Donald Trump. But I want to talk about the Fed a little more broadly here, because it does seem like we are still maybe sort of dealing with repercussions of the Fed's last decision, as well as press conference, and then what's going to happen going into next year. We just talked to someone earlier in the show who said maybe after 2 cuts this year, we could even get hikes beyond that. What are you watching that you think will be informing the Fed most?
Well, thanks for having me, Julie, and happy holidays. First, we think it's, at this point, we think it's unlikely that we get hikes. We think it's more likely that we get pauses. We think that the Fed is paying very close attention to inflation data. The Fed has a reaction function, so they look at income and economic data, and they react based off income and economic data. And based off inflation this year, inflation has been pretty much sideways, particularly over the past 3 months. PCE inflation was 2.6% in January of this year. It was 2.4% in November. Core inflation has also been very sticky. So we think that, if inflation doesn't slow as the Fed expects in 2025, then we're likely to see more pauses. But our baseline forecast is that we get 2 to 3 25 basis point cuts in 2025. But again, if we do get a reacceleration in inflation, or if inflation doesn't decelerate as the Fed expects, we're likely to see less Fed cuts than our baseline forecast.
And what about the labor market, Olu? Just thinking about the jobs market, we have the monthly non-farm payrolls, which have been steady, surprisingly steady all year long. Jobless claims also, they've spiked in a few weeks, but really haven't been a cause for concern. What are you looking for there as potential hairbingers of maybe some trouble in 2024?
Right, so it's still a good, it's still a good labor market. So the labor market went from being very good to good. Last year, job growth, particularly early last year, job growth was averaging over 200,000. That was clearly unsustainable. Job growth is weakened in 2024. We've seen an increase in the unemployment rates. We've also seen some slowing in wage growth. We've also seen declines in quit rates. Several labor market indicators are pointing to a weaker labor market. But again, it's still a good labor market. It's still supporting the U.S. economy. Wage growth exceeds inflation, so that's a positive for consumers. We think that if we see big declines in employment, that will be a sign for the Fed to react again, by cutting rates more aggressively than what they forecast at the December Fed meeting.
Of course, Olu, when we look at inflation, it is still above the Fed's 2% target. We've got an administration coming in whose policies, particularly with regard to trade, some economists have said is going to be further inflationary. Is that what you expect? And what are you looking at in terms of inflation targets for 2025?
Right, so there are a lot of unknowns there in terms of potential policies. But I think in order to evaluate the potential impacts of tariffs, I think it's important to look at what happened during President-elect Trump's first term. So between 2016 and 2020, when tariffs were implemented, they were implemented on just limited goods, such as washing machines, aluminum, and so on. We didn't see any big acceleration in inflation. Actually, inflation went up from 2.1% in 2017 to 2.4% in 2018. And inflation in 2019 and 2020 were actually below 2%. So it depends on a lot of things. It depends on the transmission mechanism. It depends on how extreme the tariffs will be. And so there's so many factors that come into play in terms of how tariffs will affect the U.S. economy, particularly inflation. But our view is that, if extreme tariffs are implemented, if broad-based tariffs are implemented, there will likely be an inflationary shock. There will be an increase in price levels, and that could make the Fed's job more difficult in 2025. So that could result in less rate cuts than what we're currently forecasting.
Can you talk to us about the housing market and specifically rates? Because I'm looking at the 30-year at about 6.85%. It's off the highs which we saw in late 2023, but you're expecting rates to moderate next year. But at the same time, I'm also seeing that since the Federal Reserve started cutting rates in September, we were just talking about this with the last guest, we've seen the 10-year actually rise. So what forces do you see at work in the rates market for mortgages?
That's a great point. We've seen a spike in 10-year yields since the Fed's made it in September. There's several factors that affect the 10-year yield. Fed policy expectations, inflation expectations, a term premium, and so on. But I think what could be a play. We think what could be a play here is just really the strength of the U.S. economy. The U.S. economy has been particularly strong this year. It's been stellar, particularly when you compare it with other G7 economies. GDP for Q3 was revised higher to 3.1%. GDP in the second quarter was above the longer run pace. It was at 2.8% on an annualized basis. And several economic indicators just point to a strong U.S. economy. And we think that's partly why we're seeing those upward pressures on long-term yields. Now, in terms of housing is an interest rate sensitive sector, and it's been weak for a couple of years. But we do expect that we're going to see more inventory come online. Actually, if you look at existing homes for sale, we've seen a slight increase this year. So we do expect that we're going to see more homes come online next year, and that should lead to slower house price growth in 2025.
Here's hoping. Olu, thank you. Appreciate your time.
Thanks, Julie.